Welcome back to the Stack. It is Thursday afternoon.
February 19th.
Right, February 19th, 2026. And the closing bell has, well, it just finished echoing through the exchange.
And it was an interesting close.
It really was. If you are staring at your monitors right now, you are probably seeing a lot of red. Sea of red, honestly.
Across the board.
The Dow, the S&P 500, the NASDAQ, they all rolled over today. They ended up shedding roughly 0.3% each.
Which is a stark contrast to yesterday.
Exactly. Yesterday, we had this solid, optimistic advance. People were feeling good. And today, the market seemed to remember that the world is, it's a complicated, messy place.
It is messy, but I mean, for us, messy is interesting.
Messy is profitable.
Straight up. The screens are red, sure, but if you look at the volatility indicators, they are finally waking up. And for the strategy we run here for what we call Theta Fuse, that is exactly the environment we want.
Right, and let's establish that identity right out of the gate for this deep dive. We aren't just reporters here.
No, we are not just reading the ticker tape to you.
We're option strategists. We are looking at all this macro data through the specific lens of volatility and premium collection. Because when the average investor sees red and panics...
We see expensive insurance.
Exactly. When the market gets fearful, the price of that insurance goes up. And as Theta Fuse, we are the ones selling that insurance to the people who are panicking.
We want to be the house.
So, to you listening, take a breath. Ignore the red percentages for just a minute. While the headlines scream about a sell-off, we're going to unpack where the actual opportunity is hiding today.
Because we have three massive narratives colliding, it's rare to see this much macro data hit the tape at once.
It feels like everything is happening simultaneously. Let's outline the mission for today's deep dive. First up, we have a historic changing of the guard in retail.
The battle of the titans. Amazon versus Walmart.
Number two, we have what we're calling the rate paradox. The Federal Reserve is saying one thing, but the mortgage market is doing something completely different.
It's a massive contradiction.
And third, the wall of worry. Geopolitics, oil spikes, trade deficits, and maybe most importantly, some real cracks in private credit.
The headwinds are blowing hard today.
They are. But again, fear equals high implied volatility, which is our playground. So let's just jump right into the top of the food chain. The historic retail shift.
This is a huge milestone.
For decades, if you asked anyone who the biggest company in the world was by revenue, who actually moved the most volume of goods, the answer was always Walmart.
Bentonville, Arkansas, the undisputed king of sales.
But today, we got the full year data for 2025, and that reign is officially over.
It's mathematically over. Amazon has officially surpassed Walmart in annual revenue.
Let's hit the exact numbers because they are staggering. Amazon posted $716.9 billion in revenue for 2025.
$716.9 billion.
And Walmart trailed just slightly at $713.2 billion.
So Amazon takes the crown. And this isn't just about two companies trading places on a leaderboard. It's highly symbolic.
It's the shift from brick and mortar to digital.
Exactly. It's the shift from you driving to a massive physical store to the logistics network bringing the store directly to your front porch.
That transition has been happening for 20 years, but today is the day the digital and logistics model officially became the dominant force in the global economy.
But we have to be very careful here, because if you just read the headlines, Walmart loses crown, you might think Walmart is a dying legacy brand.
Which is absolutely not true. I mean, look at their chart.
The loser in this scenario isn't exactly losing.
Walmart stock has more than doubled over the past 2 years.
Their market cap is comfortably above $1 trillion. They're a juggernaut.
And they've been making these really aggressive structural moves to change their identity. They don't want to just be seen as a grocer anymore.
Right. Let's talk about the listing pivot.
Yes, the NASDAQ move.
To a lot of people, changing the exchange you're listed on just sounds like back office paperwork.
Right. Who cares if it's the NYSE or NASDAQ, right?
Yeah. Exactly. But in the institutional world, the NASDAQ is the home of tech. It's where Apple and Microsoft live. Walmart moving their listing to the NASDAQ is a massive neon sign to the algorithms and the fund managers.
It's them saying, we are a technology company.
We are an automation company. We are an AI company. We just happen to use that tech to sell groceries.
And they did report earnings today, which is partly why we're talking about this. They posted a modest quarterly beat.
But the stock was super choppy. It seesawed all morning. It dropped early, then reversed.
Why the hesitation if they beat the numbers?
It was the guidance, the forward-looking statements. Walmart flagged some quote-unquote headwinds for the year ahead.
And you can see the growth disparity when you look at the forecasts. Walmart's net sales are forecast to grow 3.5% to 4.5% this year.
Which is slower than last year's 4.7% pace.
Right. And while growing a $700 billion base by 4% is huge.
It's just not fast enough to catch Amazon's online engine. Amazon's growth is compounding faster. That gap between them is only going to widen from here.
But there was a silver lining in that Walmart report. And I think for you, the listener, this might actually be the most important data point of the day.
The inflation commentary from the CFO.
Yes. The Walmart CFO came out and explicitly said food inflation looks to be coming down.
And the data backs it up. Walmart U.S. grocery inflation was only 0.6%.
0.6%, that is basically flat.
It is well below the national trend we've been fighting for years.
It is borderline deflationary at the shelf level. And that is massive news for the consumer. We talk about this cost of living crisis nonstop. But if the biggest grocer on earth is saying prices are flatlining,
it means the fever is breaking, the consumer is getting some relief.
And you can see it in their shopping habits. Walmart's like-for-like grocery sales rose by mid-single digits, so people are still spending.
They are resilient. They are just hunting for value. They might be buying the store brand instead of the name brand, but the volume is still there.
Okay, so let's tie this back to our primary mission, the Theta strategy. We talked about this specific dynamic on Tuesday.
We saw this divergence setting up perfectly.
Right. And I want to explicitly state this for everyone listening. This macro environment is exactly why we were selling puts on Amazon on Tuesday.
Exactly.
You want to own the undisputed king of cash flow.
When you have a market where the new top dog is generating over $716 billion in sales, betting against them collapsing is one of the highest probability trades you can make.
Let's break down that mechanic real quick.
Yeah.
When we sell a put on Amazon, we're agreeing to buy Amazon stock at a specific lower price if it drops.
And in exchange for making that promise, we collect cash up front. Premium.
Right. We collect the premium from the traders who are terrified the market is going to crash. We act as the insurance company for the fortress that is Amazon.
We just let time decay work in our favor.
Okay, let's pivot to our second narrative, the interest rate paradox.
This is a wild one.
It really is a massive contradiction in the bond market today. We have the Federal Reserve acting hawkish on one side, and the mortgage market basically throwing a party on the other.
They're reading two completely different economies right now.
So let's look at the Fed side first. We had comments recently from Neel Kashkari, the Minneapolis Fed president.
And he did not sound like a guy ready to slash rates.
Not at all. His exact quote was, "We're pretty close to neutral."
Which is Fed speak for, don't expect any more cuts anytime soon. Neutral means the current interest rate is neither stimulating nor restricting the economy. It's balanced.
He's asking, does inflation really get all the way back down to 2%? Or is it sticky?
And he pointed to a very specific modern reason why yields might need to stay high. The data center boom.
This is so fascinating. He explicitly mentioned that the massive investment in AI infrastructure, these giant data centers, is keeping yields elevated.
It makes perfect sense when you think about the plumbing of the financial system. These tech companies need billions and billions of dollars in capital to build these facilities.
They are competing for funds in the bond market.
Exactly. That massive demand for capital keeps the neutral rate higher than it was during the last decade. The Fed simply can't cut aggressively if the tech sector is already running red hot and sucking up all the oxygen in the credit markets.
So Kashkari is saying we have to hold the line. That's side A. But then we look at side B, the actual cost of borrowing for a normal person.
The plot twist.
The 30-year fixed mortgage rate just dropped. It hit 6.01% today.
6.01, we are knocking on the door of the fives.
That is the lowest level we have seen in nearly 4 years, since early 2022.
Some data providers are calling it the lowest in more than 3 years, but either way, it is a massive, massive drop from where we were.
If you bought a house in 2024 or early 2025,
you are sprinting to your loan officer right now.
Refinance applications have to be surging.
They absolutely are. But here's the paradox. Why is the bond market dropping mortgage rates to a 4-year low when the Fed is standing at a podium saying, we're at neutral?
Right. Why are they fighting the Fed?
Because the bond market is looking right past Kashkari. They are looking at the data we just talked about, that Walmart 0.6% grocery inflation.
They see the deflationary trend at the register.
Yeah.
Yes. And they see Walmart forecasting headwinds. The bond market is betting that the Fed is wrong. They are pricing in an economic slowdown, and they believe the Fed will be forced to cut rates sooner rather than later to save it. So we have this massive tug-of-war. Fed says AI keeps rates high. Bond market says consumer slowdown brings rates down.
And while they fight, we sit in the middle and collect the premium on the volatility it creates.
Always. Okay, so we've covered the retail shift, we've covered the rate paradox, but we need to address the actual red on the screens today.
The wall of worry.
The headwinds. Because while cheap mortgages are great, the algorithms sold off today for a very specific reason. Fear.
Geopolitical fear is back in the driver's seat.
It is. U.S.-Iran fears are totally dominating the terminal headlines right now.
There was that Axios report that dropped.
Right, the Axios piece suggesting that the Trump administration is, quote, edging toward conflict or leaning toward conflict with Iran.
And the second the algorithms parse the words Iran and conflict, they buy oil and they dump equities. It's a reflex.
We saw the price action immediately. Brent crude jumped above $71 a barrel.
WTI is hovering right near 66.
This is the biggest daily jump in oil we've seen since last October.
And we have to analyze what oil spikes do to the macro picture. Oil is a universal inflation tax.
It hits everything.
Everything. If oil spikes and sustains these levels, that amazing deflationary story we just got from the Walmart CFO, it dies on the vine.
Because it costs more to ship the groceries to the store, and it costs the consumer more to drive to the store to buy them.
Exactly. And that scares the absolute life out of the Fed. That is how you get stagflation.
And you can see the fear manifesting in the ultimate safe haven, too. Let's look at gold.
The fear gauge.
Gold rose back above $5,000 an ounce today.
When gold is pushing those levels, it means institutional money is seeking hard shelter. They're hedging against systemic shocks.
Speaking of systemic issues, the trade deficit numbers came out today, too, and they're playing into this broader market anxiety.
The December data was pretty eye-opening.
The December trade deficit surged 33%. Just in 1 month, it hit $70.3 billion.
A huge spike to end the year.
Which brings the annual tally for 2025 to a total deficit of $901.5 billion.
900 to 1.5 billion. Now let's put that in context.
Let's compare it to 2024, which was the final year of the Biden administration. In 2024, the deficit was $903.5 billion.
So we are talking about a difference of $2 billion on a base of $900 billion.
It's virtually identical.
It is. And the takeaway here, and we are just looking at the math, not the politics, is that despite a full year of this new, often erratic tariff policy environment under Trump, the overall deficit barely moved.
The tariffs shifted the landscape of where things came from, perhaps, but they didn't dent the actual aggregate deficit.
Not at all. And if you look at the culprits, it was massive imports of gold, pharmaceuticals, and IT equipment. Telecommunications.
Right, things with highly inelastic demand. You can't just stop importing vital IT equipment if you were trying to build out the AI data centers we were just talking about.
Exactly. The demand is fixed, so the imports continue, regardless of the tariff friction.
This makes for a very interesting dynamic, especially considering President Trump's recent comments. Just a few days ago, on February 13th at Fort Bragg, he made a very specific prediction.
He claimed that the trade deficit would go into positive territory in 2026. A trade surplus.
But the data we just got, a 33% surge in December, suggests we are entering 2026 moving rapidly in the opposite direction.
And again, for us as options traders, that gap between a political prediction and the hard economic data equals volatility. If the administration tries to aggressively force that number positive, it means more trade disruptions.
More uncertainty.
And higher implied volatility.
Okay. We need to talk about the final headwind.
Yeah.
And this is the one that really caught our attention. It's the credit crack.
The canary in the coal mine for private credit.
I want to do a crucial callback here for our listeners. We warned you about private credit risk this weekend. We dedicated time to it, and we said cracks are starting to show in the plumbing.
And today, the pipe burst.
Blue Owl, ticker OWL.
They just halted redemptions on their retail private credit fund.
This is massive. Let's explain why this matters, because a lot of retail investors might not understand the mechanics of these specific funds.
Right. Private credit has been booming. People want to yield, so they put their money into these funds that loan cash directly to private companies.
But the underlying assets, those private loans, are highly illiquid.
Extremely illiquid. You cannot just click a button and sell a private business loan to someone else on a Tuesday afternoon. So these funds have gates. They have fine print that says, in times of stress, we can stop you from taking your cash out.
And Blue Owl just pulled that lever. They gated the fund.
When a fund tells a retail investor, no, you cannot have your money back right now, panic spreads instantly.
It's the Hotel California. You can check out, but you can never leave.
And we saw the immediate reaction in the market. Blue Owl stock is down significantly today, and we are seeing contagion.
Other tickers are flashing red. OBDC is down.
It signals stress in the actual plumbing of the financial system. When markets get scared about Iran or tariffs, people want the safety of cash. If they find out their cash is trapped in a private credit fund, they panic sell their liquid assets to compensate.
They sell their equities. They sell everything else.
Exactly. It creates a liquidity vacuum.
Okay, we have covered a massive amount of ground today. Let's synthesize all of this into the Theta Fuse wrap-up.
Let's connect the dots.
We are looking at incredibly conflicting signals across the board. On the bullish side, we have Walmart signaling grocery deflation. We have Amazon generating historical cash flow. We have mortgage rates dropping to 6%.
All of which is great for the consumer.
But on the bearish side, the war drums are beating regarding Iran. Oil is spiking above 71. Trade deficits remain sticky and massive. And private credit is literally freezing up as we speak.
It is the definition of uncertainty.
And in our world, uncertainty equals high implied volatility.
High value is expanding.
And high-fi means expensive options.
Which is the core of our strategy. As Theta Fuse, we do not run from this fear, we sell it.
We sell the premium to the gamblers who are trying to bet on the directional outcome of all this chaos.
Let them guess what happens with Iran. Let them guess what the Fed does. We will just sell them the puts.
Which is exactly why we reiterate the Amazon put selling strategy. You capitalize on the king of cash flow. You find the absolute most stable fortress in the market, and you sell insurance on it amidst the macro chaos.
Collect the premium. Let Theta decay the contract and profit from the passage of time.
That is the playbook. Now, before we sign off, I want to leave you, the listener, with a final provocative thought. A 2026 prediction of our own to mull over.
Let's hear it.
We have Trump predicting a trade surplus. We have Walmart forecasting headwinds. We have the Fed sitting at neutral. But here is the real question for the next few months. If mortgage rates are sitting at a highly attractive 6%, but oil goes to $100 a barrel due to conflict with Iran.
Does the housing market recovery get strangled in the crib?
Exactly. Does the cost of energy completely wipe out the benefit of cheaper borrowing?
History tells us energy costs act as a massive wrecking ball to consumer spending. It is the ultimate wild card.
It is. So keep a very close eye on energy. And seriously, watch that Blue Owl situation.
Yeah.
Because if liquidity truly dries up in private credit, this neutral Fed is going to look very, very different next month.
They will be forced to pivot.
They will. All right, that is our deep dive for today. Keep your Theta positive.
And your delta manageable.
We will see you at the next bell.